Good afternoon, and welcome back to AIABA's Auto Talk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders as always. Anyone who has registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Now, please join me in welcoming back our good friend, Cox Senior Economist Charlie Chesbrough. Charlie, I can't think of a better time to have you on. There's been a lot of changes and uncertainty in the air, and we're excited for your presentation. So I am going to let you take it away.
All right. Well, thank you, Rachel, and thank you to everybody for joining today. And we're going to give you the Outlook update as to what we're seeing out there. And I'm going to walk you through a lot of the data that we have here at Cox Automotive and give you an update as to what we're seeing out there regarding inventory and sales. But there's a few main areas I want to cover. And really, the biggest one here is the possible recession. And that's really what hangs on the market here today. Is that we've had a pretty good start to the year so far in both the new and the used market. But the concern is that when we get to the second half of this year, are we going to start to see a slowdown? Have the interest rate increases that the Fed's been doing over the last year, are they going to really start to take a bite out of consumer activity in the economy? That's what a lot of folks are worried about. And I'll walk you through some of the things that we're watching, but what the outlook is on that. And then I want to give you an update on the inventory situation for the new vehicle market. It's clearly been changing dramatically. When we last met in early December, the situation had definitely improved. Well, it's improved even more since then. But it's not improved for everybody out there. And that's one of the important points to make, is that the industry really finds itself in a very varied position, with some brands seeing inventories building and other brands still seeing things very small. And then I want to walk you through the used vehicle market, give you an update on what we're seeing there in terms of some of the sales activity and inventory, and the phenomenon we're seeing right now regarding prices. Used vehicle prices are actually falling right now at the retail market, but when we look at the wholesale market, it's a little bit of a different story. I'll take you through that. And then lastly, I just want to give you an update on the EV revolution. 2022 is a big year for EVs and hybrids, and the expectation is it's going to be a big 2023 as well, possibly thanks to the new Inflation Reduction Act and the implications that may have for the market. But let's start today by talking about inflation, and that's really public enemy number one. This is a chart that's showing the Consumer Price Index. The year-over-year change in that index is put out by the Bureau of Labor Statistics. And I've circled there in green on the far right where we are today. We just got the most recent data point from February, and inflation was running on a year-over-year basis at 6%. So it's been coming down here since last summer, when we topped out at around close to 9% inflation. It's been coming down as we expected. The Fed had been telling us that a lot of this inflation was cyclical, that it was going to start to come down. We know that gasoline prices broke last summer, as well as in the vehicle market. We saw our own prices starting to come down, certainly in the used market last fall. But we're still looking at very, very high inflation rates. We're still at levels that we had not seen since 1982. So we're still at 40-year plus levels of inflation. The big question for the market is can the Fed get this consumer price index, the inflation rate, back down to sort of the long-term goal of 2%? That's that red dot on there. Can they get us back to that level of inflation without tipping the economy into recession? And they've been raising interest rates to slowly curtail demand, to try and create a soft landing. But the concern is that the Fed's not going to be able to do that. They're going to get too aggressive on interest rates, and they're going to lead to some sort of a spike in unemployment and create sort of a much more difficult recessionary outcome. That's the concern. As of yet, though, it's hard to see any signals out there that we're getting anywhere close to a recession, or things are getting anywhere near an area where we need to worry too much. This is the unemployment rate. I've highlighted there in green on the far right where we are today. Unemployment stands at 3.6%. That was the most recent number announced at the beginning of March for the month of February. That was up a little bit from the month before, but we're still looking at unemployment rates that we haven't seen since the late 1960s. And in fact, you could make an argument that the unemployment rate we have today is really the best unemployment rate we've ever had in our modern economy. The only times when unemployment has been lower was during the Korean and Vietnam Wars, when a number of folks were overseas fighting in those wars, and they weren't available to work. So the unemployment situation remains very, very strong out there. But as I said, the concern is that unemployment is going to start to spike here, maybe later this year, as employers start to lay off more and more workers in response to these higher interest rates and the economy slowing. But one of the big things that has to happen out there for the Fed to really see that there's dramatic impact of what they're doing is that for personal consumption has to change. This is real personal consumption expenditures. This is the money that you and I spend when we go out each month and buy goods. And you can see this normally grows at around a 2 to 3% rate. That's been our consumption growth in this economy for quite some time. And this is the biggest part of the US economy. This is about 70% of all economic activity in our country is you and I going out and buying stuff. You can see from where we are on the far right up there, the dotted green line, we're nowhere near seeing personal consumption in negative territory. We would expect to see that if we were in a recession or heading into a recession, consumers would be pulling back significantly on their consumption. We haven't seen that yet. And I've highlighted in red there back in 2008, 2009, when we had the Great Recession, consumption fell below zero, and that's why we had that terrible recession that we did have. But you can see after we had the craziness of COVID, where things went down and then went up dramatically, we can see that the market is essentially settled with personal consumption, and this is real. So this is inflation adjusted, still growing back at our regular 2% rate. So all of this inflation concern and this increase in interest rates to really slow down economic activity doesn't appear to be having any major implications just yet. But as I said, this is what we're watching for. Will the second half of the year start to reflect this new Fed policy? Even if it does, though, we don't see the recession risk for the vehicle market as being anywhere near what it was back during the Great Recession. This is a chart that's looking at the recession risk and what the light vehicle market did back during the Great Recession. And that's what's on the left here. And you can see that vehicle sales prior to the Great Recession, which started in December of 2007, were humming along in around a 16 to 17 million pace. Then we had the major recession kick in. Vehicle sales fell dramatically in 2008 and 2009. We bottomed out at 10.4 million in 2009 before we started a very long and prolonged recovery. That's what happened during the Great Recession period. On the right is what we're looking at here during the global pandemic period. And here we can see we were humming along at a 17 million plus market till 2019. COVID came, vehicle sales fell, and then we had a little bit of an increase last year, or excuse me, in 2021. Then they fell again last year until where we are today. We're looking at vehicle sales in 2022 at 13.8 million. We've already fallen quite a bit off of the levels we had before. We're down over 3 million units from sort of our normal pre-COVID levels. So the concern is if we have a recession, it's at this point, it would be more like falling off of a curb than falling off of a cliff like it was back in 2008 and 2009, the previous recession. So in terms of downside risk, we've already fallen a whole bunch. Certainly there is downside risk, and I've highlighted in red sort of what our pessimistic scenario outcome is. And that's if there is a major recession, the Fed is not successful in mitigating that soft landing, then we could see vehicle sales fall to even further into the mid 12 million range. But there's also the upside potential, which I've highlighted in green, which is a successful soft landing, that the Fed is able to not send the economy into recession, is able to get a hold of inflation. And we could see an even more positive outcome. We're kind of splitting the difference a little bit. Our baseline assumption for this year is things are going to get a little bit better, and that we're going to be looking at a vehicle market that's going to be fighting the headwinds of rising interest rates and all the challenges that a slowing economy brings, with the benefits of a return of inventory. And that's really been holding back the market the last couple of years. Inventory is definitely getting better. With more inventory is going to be more sales and also more discounting, which should also help sales. So we think that's going to be the balance, and it's going to take us to a vehicle market that gets a little bit better in 2023. And as I said, part of the reason we just don't see the downside risk quite as substantial if we do have a major recession is that we've already lost a big chunk of the normal vehicle buyers that we would lose during a recession. This is some data that comes from our dealer track data. And on the left here, this is showing the subprime, which is in orange, and then the deep subprime, which is in red, what their share of the new vehicle market is for purchasing of vehicles. And I've highlighted there in March of 2020 when we had our last peak. Since then, since COVID came, you can see the role of subprime and deep subprime has fallen dramatically. And then now you can see deep subprime in red has almost become non-existent in the new vehicle market. Those folks have essentially been chased out of new vehicle sales. The higher interest rates, the high price points is just too much. Has made new vehicle sales much more unaffordable for subprime and deep subprime buyers. And we're seeing a similar story for the used market as well. On the right, that is showing subprime and deep subprime share in the used market. And again, you can see that once COVID came in March of 2020, a number of these folks dropped out of the market. Their role, their share of vehicle sales fell dramatically. And what that means is what remained in both of the new and the used market was a much more affluent vehicle buyer. Folks that could afford these high prices and weren't as vulnerable to these high interest rates are what remain in the vehicle market. And so when we talk about there's a more affluent buyer out there, this is part of the reason that the folks who could not afford vehicles have left the market. And that's changing the composition of who's shopping today. So this is a chart that's showing what is the average APR that folks are signing up for when they contract to make a purchase of a new vehicle out there. And you can see here that this is going back to 2018. The prior to COVID, the average APR out there ran sort of in the 6 to 6.5 range. Then COVID came, and you can see that this started to trend much lower. That wasn't because the average interest rate out there was substantially decreasing. It was falling on average because of the composition of who was buying. We were getting a much more affluent, higher income, better FICO score buyer in the new vehicle market, which meant the average interest rate was going lower. All of the subprime folks were leaving the market and taking their high FICO scores and their high interest rates with them. But you can see that starting in the spring of last year, the average APR started to rise dramatically. And that's where we're reflecting the impact that the Federal Reserve's interest rate increases are having on the new vehicle market. They've jacked up those average interest rates tremendously. And really now it's very difficult for anybody to escape these rates. And that's making this affordability issue that much more of a challenge this year, because we're not only dealing with high prices, but we're also dealing with these high interest rates that are making those high prices that much more difficult on the monthly payment. And I'll show you a slide on that in just a moment. So the other interesting thing when we look at about the different APRs is that the brands themselves cater to different customers out there. They don't all have the same type of customer that's getting the same APR interest rate. And what this chart is showing is what is the average APR for the major brands out there. And it really reflects this variation that we have in the marketplace. At the bottom there, if you look on the left side, back in 2019, in green, we've got Honda, and in light blue, we have Subaru. Their customers on average back in 2019 were paying around a 3.5 or a 4% interest rate when they were buying a vehicle. At the same time, you can see at the top there, and in red and in orange, you've got Jeep and Nissan. Their customers were paying 7.5 or 8.5% was the average APR that they were signing up for. And this is at the same point in time. So you can see that the average customer for these different brands had a different income level, had a different credit score, such that they were able to qualify for different interest rates. And you can see that once we went through sort of the COVID period and COVID came, we saw this great variability back in 2019 of what all the different interest rates were that the brands offered. We saw that started to change dramatically until you can see about a year ago, all these lines really started to consolidate, suggesting that the marketplace was becoming much more homogeneous, where the average income of the buyer was much more similar. The average FICO score of the buyer in the market was much more similar. And so the average interest rate that everybody was offering out there became much more similar. And you can see that now it's rising, though, for everybody, except you can see that both Honda remains quite low and Subaru still remains well below some of their competition out there. We would expect that if there is a major recession this next year, that those brands that cater to the higher APR type customers, like your Nissan, like even your Volkswagen there and your Royal Blue, they may be a little bit more vulnerable in a recession than some of your other brands that cater to more of a higher income, better FICO score customer. And that's simply because those customers are going to be paying a higher interest rate. And when we look at the luxury brands, it's also a very similar story. We've got all the major luxury brands here. And I think one of the key takeaways here is one, you can see that dotted line. That's the national average. And all major brands, for the most part, are well below the national average, suggesting that the average luxury buyer has a higher income, has a better FICO score, and so they're going to qualify for a better interest rate. I think that makes intuitive sense. It's what we would expect. But the other interesting thing here is that red line. And you can see that Mercedes, that's who's in red, back in 2019 was sort of in the middle of the pack there in terms of their average interest rate. But now it's risen dramatically until you can see that where we are today, the average APR for a Mercedes customer is above the national average. It's much more like those interest rates that the broadband brands are paying on that previous slide. This again would suggest that if there is a major recession this year, that it may be that Mercedes might be more vulnerable because their average customers are paying a much higher average APR than you can see, say, an Acura customer there, almost 5 percentage points higher on average, suggesting they're going to be more vulnerable if there's a downturn. So the other interesting thing we're seeing out there in response to these higher interest rates is that the customers themselves are changing how they're doing vehicle financing. This is a chart that's looking at what is the cash share of vehicle purchasing. And cash meaning folks that came in and just slapped down $50,000 for a vehicle, for a new vehicle, or $25,000 for a used vehicle. In orange on this chart, you can see that's the used market. And 3 years ago, back in December of 2019, about 59% of sales were cash purchases in the used market. And that's risen to about 62%, our most recent data point in December. So not a big increase in the used market. But in blue is the new market. And you can see back in 2019, 14% of new vehicle sales were a cash buyer. And so far today in 2022, it's risen to 2022, it's risen to 22%. And so it's up substantially. And I think what we're seeing here is a reflection of many of the buyers looking at those APRs that the brands are offering. And they're saying, forget it, I'm just going to go ahead and pull money out of my savings account and offer the money and spend the money myself. And so that's one of the interesting things that we're seeing happen out there. But all of this means that monthly payments are going up substantially. And this is a chart that's looking at the average loan and lease payment out in the marketplace. And I've coined this COVIDflation. And if you look at the average increases from March of 2020 through December of 2022, they've been substantial. In green there, you can see the average loan payment. We finished the year with the average loan payment at $785 and the average lease payment at $661. That loan payment is an increase of 29% from what that payment was back in March of 2020. And that lease payment is an increase of 33%. So really, we've seen a monster amount of inflation. And normally we see monthly payment inflation of about 3 or 4% per year. So this is really quite a dramatic increase. And I think we're going to have a lot of consumers out there when they return to market are going to be in for quite a surprise as to how much these payments have really gone up. And the other thing to point out here is just, we've seen that we know that leasing has fallen dramatically. And part of the reason for that is the leasing offers just haven't been very good. And as you can see, leasing payments have actually risen more than your purchase payments out there. So that's, again, part of the reason why leasing just hasn't been that strong. But what we're looking at here is the national average. And so we got to be careful when we're looking at the aggregate because a lot of information gets lost. And it's that old saying, my head is in the oven, my feet are on ice. On average, I'm perfect. Well, we need to kind of get away from sort of the national averages to really understand what's happening under the hood. And you can see that even though the nation may have been up 29% on those average loan payments during that March of 2020 to December of 2022, how much it's increased for the different brands varies greatly. And that's what this chart is showing here. I'm showing what has been the average monthly payment increase for these different brands. And you can see on the far right here, we've got Cadillac, Jeep, GMC, Dodge. These brands have seen a huge increase in their average monthly payment. Somewhere in the neighborhood of 40 to 45%, just in that time period. One would think that if there is a recession this year, that these brands that have had a substantial increase in their monthly payments may be a little bit more vulnerable than those brands on the far left. Brands like Subaru and Kia and Toyota that have only had 15 to 20% increases in their average monthly payment during this period. So, uh, again, this is just kind of revealing that who may be vulnerable if we have a downturn. We would expect that many of these Detroit 3 brands that have had such a substantial payment increase are really going to be in for a surprise when their customers come in and they're looking to buy again. And they're just looking at payments that many of them, are not going to be able to even consider. And so that's one of the issues that we're really dealing with as we enter into the later part of this year. And all of that kind of leads into this affordability issue. And I know I've shown this slide to you guys before, but I think it's really just important to point out sort of this. We're seeing this payment inflation over the near term, certainly as a result of COVID and the inventory shortages. But this has been a long-term issue for the industry for quite some time. And what this chart is showing is it's looking at the market share of the new vehicle market by different price bands. And at the bottom there are the different price bands. And the key takeaway is that back in 2012, 54% of all the vehicles sold out in the new vehicle market had an MSRP below $30,000. 54%. By 2022, that finished with just 14% of the market had a price point below $30,000. And it's all been shifting into much higher price categories. And in 2012, just 6% of the vehicles sold had an MSRP above $50,000. In 2022, that's risen to 39% of the vehicles. So it's becoming a much more affluent market. This affordability issue is really going to be tested this year because of these high interest rates. As I said, though, we are a little bit insulated because a lot of volume has already been lost. But the other interesting thing is that you can see the new vehicle market has essentially abandoned the $30,000 price point. There's no more products there, very few products available at that $30,000 price point. These folks are being pushed into the used market. And that's changing some of the dynamics of the used market because there are now more buyers there than we would normally have. And that's changing some of the pricing. So I'm going to talk about that in just a minute. So let's get into the inventory situation out there. And as I said at the start, the inventory situation has changed dramatically. On the left here, this is looking at available supply from our vAuto data. And this is essentially a sum of what is on dealer lots all across the country. And I've got all the different years here. 2019 in gray, and light blue is 2020. In dark blue is 2021. And you can see when that line fell in the spring of 2021, that's what really started this inventory shortage. In red is 2022, what happened last year. And you can see that in July, we really started to see this number change, and it started on a much better trajectory. And then yellow is where we are today. And as we stand today, we've got inventory up about 68% from where we were this same point last year. That's about 730,000 more vehicles on dealer lots across the country right now. So the inventory situation has improved dramatically. And on the right here is days of supply, or how long will that inventory last based on our current sales pace. And you can see that in red, we had a nice recovery of the days of supply from the low levels of about 30 days. It rose up to about 60 days. And that's pretty much where we've been through most of this year. We're hovering around 55 to 60 days of supply, up about 60% from where we were at this same point last year, but still well below sort of the normal pre-COVID levels that we had before. So the inventory situation has changed dramatically. But it's also changed dramatically for the different brands out there. And they're not all in the same boat, as I told you before. This is a chart that's looking at days of supply for the major brands. And you can see on the far right here, some of these brands have inventory levels that are really starting to accumulate. You've got Dodge and Volvo, Buick, Jeep, Chrysler, well over 100 days of supply for many of these brands. And at the other end, on the far left, you have a number of Asian brands like Toyota, Lexus, Kia, Honda. They're still looking at very, very tight inventory situation. And so this is where the difficult part here in the second half of this year is how are these different brands going to respond to this? Will the American brands start to do significant discounting to try and move that metal and not let inventory levels get too high? And will the Asian brands start to respond? Even though they probably don't need to raise incentives, they may not want to risk losing market share, but they may be willing to do that in order to maintain pricing integrity. So this is going to be the real battle here in 2023 as to how the different brands are going to respond to this changing supply situation. But one of the things that's really dramatically changed out there is transaction prices. Oh, and it looks like my number got cut off there, but this is looking at the average transaction price, and I think it's really a good way to summarize what's been going on in new vehicle prices. And you can see that dark blue line back in 2021. In May was really when the supply shortage began, and that's when new vehicle prices really started to take off. But you can see in red last year, they more or less returned to sort of normal pricing patterns. And in yellow is where we are today. And prices right now stand at about 5% above where they were at this same month last year. So we are not done with inflation yet in the new vehicle market, but the pace of inflation has definitely slowed. But we are starting to see out there that although transaction prices are high, the strength of those prices is actually starting to change a little bit. And this is a chart that I've called the seller's market, and it's looking at some of the discounting that's going on around transaction prices. And we can measure all of this with our Kelley Blue Book data. And what we've got here in dark blue is incentives as a percent of transaction price. And you can see that prior to COVID, these generally ran in the 10 to 11% range, was the typical incentive relative to the transaction price. But then that dark blue line fell dramatically during the tight inventory environment until it bottomed out at around 2% of transaction price until now, where I've highlighted in red, it's starting to rise again. So we had a very, very strong situation where incentives were pulled back significantly, but now we see that incentives are starting to revive. We see them starting to increase just a little bit. And we can also measure the price strength, and that's what's in green. And that is what is the average transaction price relative to the MSRP. And prior to COVID, this ran sort of in the 94, 95% range was the transaction price relative to the MSRP. Then it rose to about 102%. Essentially, the transaction price plus delivery fees was going to be the price of that vehicle, but now it's starting to fall off a little bit, suggesting there's a little bit less price strength, a little bit more discounting going on. So the seller's market out there continues. We're still looking at a situation where, for the most part, the transaction price is the MSRP, but that situation is starting to change, and it's not a surprise that as inventory levels improve, we start to see the seller's market weaken a little bit. But the question is how weak does the manufacturers want to let it get? Because they really kind of enjoy these new prices that they have out there, and it's really transformed the industry. And I mean it's transformed because we're able to do very similar levels of total revenue on much lower volumes now because we have a much higher transaction price. And that's what this chart is showing. It's a very simple back of the envelope calculation of transaction price times the total sales that we had to create a total revenue calculation. And you can see in orange there, or in yellow, is what we're doing this year. And actually, so far this year, sales are up about 7% with this data set, and yet revenue is running up 13%. And that's all due to these higher transaction prices. And in fact, it's changed so much. If we look back at 2019, back in 2019, we sold 17 million new vehicles. In 2022, we only did 13.9 million, so down 3.1 million. But in 2019, we did $647 billion of revenue. In 2022, we did $662 billion. So $15 billion more revenue on over 3 million fewer units sold. And that's really the change that these higher prices have brought to the marketplace. There's no rush to get back to normal. If revenue is your goal, we're still looking at relatively strong revenue out there because of these high transaction prices. But we know the auto industry, it's always tough for them to give up market share, to not do discounting, to let any sales not happen out there. And so the expectation is that we're going to start to see more discounting. And we can actually monitor that with our Kelley Blue Book data. This is looking at incentives as a percent of transaction price for the different brands, some of the major brands. And I've highlighted in gray what the measure is relative to where we were 1 year ago. And this is in January, my most recent data point. And then I've also got the last 4 months, so we can get kind of a current trend as to what's going on with incentives. And you can see that right now there's a very varied response out there. We can see that Chevrolet and Honda and Jeep, as well as Nissan and Ram and Subaru, all appear to be seeing a spike in their incentives more recently. However, other brands like Ford, as well as Toyota and Volkswagen, still appear to be keeping incentives relatively in check. And so this would be a metric to watch here through the course of the year as these different brands are going to start to reevaluate their strategies and whether they want to start doing some significant discounting out there. But one of the options that they have available if they decide they don't want to do discounting is to sell more to some of the different sales channels. And that's going to be one of the mechanisms that we expect the industry to leverage this year. And in fact, they've already started doing that in some regard. But there's the fleet sales and lease sales. Both of these have pulled back tremendously in this post-COVID market. And the industry could start to get much more aggressive with these if they wanted to increase sales without having to get too aggressive on the discounting. And certainly the best avenue for that is fleet activity. And that's what I have on the left here. This is looking at monthly fleet sales. And you can see that back in February of 2020, when COVID first struck, fleet sales reached a near peak, and then they fell off of a cliff. And that's when all the rental car companies, a lot of commercial companies pulled back from fleet, as well as the industry itself just didn't have the inventory available to sell into the fleet channels. They would rather keep their limited inventory that they had available for the retail channels. Well, now that the inventory levels are starting to improve, we're going to see more fleet activity, and that's exactly what we've seen. And in fact, in 2022, fleet share of the market started to rise again. And our expectation is that we're going to see more and more fleet sales through the course of this year as more manufacturers are trying to manage that balance of providing inventory for my retail channels, but not too much inventory because I don't want to get dealer lots too full so that we have to start doing heavy discounting again. And as I mentioned, the other option out there is the retail leasing. We've seen that fall tremendously here in the post-COVID market. Back in 2019, nearly 31% of all retail sales out there were a lease. But by 2020, this fell to just, 2022, this fell to just 20% of the market. This has huge ramifications for the long term for the used vehicle market, and I'll talk about that in just a moment. But over the near term, this is an opportunity for the industry that if they wanted to start to sell more vehicles, they could get much more aggressive on the leasing. But that probably means the leasing offer has to go up substantially. One area of leasing to keep an eye out for here in 2023 is electric vehicle leasing. The new Inflation Reduction Act has a $7,500 rebate for an electric vehicle purchase, but there's all kinds of requirements around that, certain income requirements, where that electric vehicle is produced and where the battery was produced requirements. There's all kinds of rules that have to be in place to qualify for that $7,500 discount on an electric vehicle purchase, but not an electric vehicle commercial sale, which would be a lease. And so a lot of folks think that leasing might have a real opportunity because that $7,500 rebate could be put right up front, essentially knocking down the cost factor for the vehicle, so that monthly payment could be substantially lower. So that may be where we see leasing starting to make a comeback here in 2023 is on electric vehicles, trying to take advantage of that new Inflation Reduction Act law. So let's talk about the used vehicle market. And as I said, we'll start by talking about the whole market. This is our outlook for used vehicle sales. And if you're not familiar, we tend to just focus on the retail side of the used vehicle market. But the used vehicle market is actually much larger than that. And in fact, when you include sales in the used market from franchise dealers, independent dealers, and private party activity, that stuff on Craigslist and Facebook, the vehicle market's much closer to a 40 million market. And in fact, in 2021, we did almost 40.5 million used vehicle sales. But in 2022, this fell dramatically to a little over 36 million. and that was due to in response to these high used prices as well as the higher interest rates, and of course a lot fewer stimulus checks going around out there, so there weren't as many transactions happening. Our expectation is going forward is that the used market's essentially going to be flat for this year and next. That higher prices and those high interest rates are going to choke off activity, and that's in the whole market. But when we just look at the retail market for new and used car dealers, we do think there's going to be a little bit of a growth potential. But again, there's just not a lot of activity expected because of the changing economic conditions out there are going to slow activity. But when we look at how used sales are doing right now, they're actually looking up a little bit to start this year. This is looking at our Auto sales data for used vehicles. And you can see that in yellow is where we are today. And so far this year, they're running up at a pace about 3% above what were doing at the same point last year. We're about to enter the big spring selling period. You can see both that red and dark blue lines sort of peak here as we enter into the early part of March. This is really the hot period for the used vehicle market when all of the tax refund checks are going out. Folks have money to go to the car dealer and actually buy those used vehicles. So we're seeing that the market as we head into the spring selling season looks particularly strong, which is a little surprising given the overall weakness of the economy and certainly the changing buying conditions out there being a little bit less favorable. The other interesting thing is that the inventory levels in the used vehicle market have changed substantially. Where we saw inventory levels starting to build in the new vehicle market, they're down substantially in the used vehicle market. And in fact, you can see here on the left, available supply at this point right now, we're down about 21% in terms of available supply of what we had the same week last year. So as we're entering into the peak selling season for the used vehicle market, inventory is an incredibly tight situation for car dealers out there. And they've not been acquiring inventory. In fact, they've been, you can see that red line last year, that was inventory levels over the last 12 months. They've been letting that fall. They have not been accumulating inventory such that now those used car dealers out there are very, very lean and mean. And if we look on the right, days of supply, you can see it's down substantially. It's now down about 23% from where this was a year ago. So sales are up a little bit, yet supply is down quite a bit. It doesn't seem to make a lot of sense, except that we know that prices are also being cut. The dealers have been cutting prices out there to make these sales happen. And so now we can see that used vehicle list prices down about 6% this week from where it was at this point last year. So they are giving back some of those price increases that we've had in order to make these sales. But again, all of this is a little surprising. And I think it goes back to that one slide on affordability, that inventory is tight, prices are still relatively high, and certainly the cost of borrowing has gone up substantially. We would think that the used vehicle market would be more constrained, but we've got a whole bunch of new buyers in there, folks that couldn't find products in the new vehicle market because of inventory levels, or they couldn't find products because of the high prices that exist. But they've been pushed into the used vehicle market, and that's helping to keep the used vehicle activity quite strong. But while we see in the retail side that used prices are actually down, when we look at the wholesale side of the market, they're actually starting to show strength again. And this is showing the Manheim Index. We just got our most recent data point from February. And on the far right there, you can see that the Manheim Index was falling from last summer through pretty much the end of the year. But then a couple months ago, it started to reverse and is showing strength again. And in fact, February was up 4.3% from January's number and was down only 7% from where we were a year ago. So we are seeing at auction that these used vehicle values are starting to strengthen. And I think it's really reflecting that lean inventory environment that used car dealers have, coupled with all of the vehicle sales, the strong activity we're seeing. It's pushing car dealers back to auction to come buy again, and that's helping to support higher vehicle prices. And I think it's quite surprising. I think we were expecting a much weaker market than what we got. But I do think it suggests that there is some support out there, that the idea that used vehicle prices are going to come crashing down just doesn't seem likely at this point. But that's not to say when we get to the second half of this year, if the economic situation changes dramatically, then certainly we might see these prices fall. Our expectation is, though, is that the Manheim Index is going to finish the year just down a little bit. And this is what our forecast is for the Manheim Index and where it finished, or where it will finish, and where it did finish in December on a year over year basis. And what we can see here on this chart is that in December of 2020, the Manheim Index finished up 14% year over year. That was the early days of COVID. Then we had that craziness in 2021 when the Manheim Index finished the year up almost 47%, as we saw those used vehicle values really rise. Then in 2022, we gave back about 15%. Not surprising, as we would expect to see values fall a little bit after the crazy year we had in 21. When we look in 2023, though, we expect going forward from here that used vehicle values are going to continue to fall, and that we'll finish the year down at about 4% on a year over year basis. And it's not until we get to 2024 that we expect to see used vehicle values rise again. But again, given the strength that we're seeing so far in the used market, it may be our outlook is a little bit too pessimistic, but that's what our expectation is right now. And part of the reason we expect to see that support out there is that we know that there is a bit of a floor on these used vehicle prices because of a limited supply of what's going to be available in the future. The less new vehicle sales that we've been doing in 2020 and 2021 and 2022 means we're going to have far fewer off-lease vehicles and vehicles for trade-in over the next couple of years. And this slide is looking at lease maturities, those vehicles that are becoming off-lease. And the heyday of 4 million a year off-lease vehicles is now behind us. And we're going to have a lean couple of years here over the next few years. And in fact, when we look out at the period of 2023 through 2025, we're going to have about 2.5 million fewer off-lease vehicles during that 3-year period than we had from 2020 through 2022. So this lean inventory environment is going to continue for quite some time, and certainly means that the CPO vehicles and these gently used vehicles, which are in great demand, are going to be very difficult to find, and certainly their values are going to remain elevated. So the last bit I just want to talk about, I know I'm talking your ear off here, but the last bit I just want to cover was just a little bit on the EV market, give you an update here as we start 2023. And so far, EVs really start to be taking off. And we've been talking about EVs forever, but I think 2022 really started to show that, in fact, we have reached takeoff stage, and EV sales really started to skyrocket. This is a chart that's showing pure EV as well as hybrid sales. And you can see they've risen dramatically. Both the light blue is hybrid, and then the green is pure EV. The EV share can pretty much be attributed to Tesla and almost entirely to the Model Y. That really had a big year last year and has quickly taken over as the number one luxury vehicle out there. But there's going to be a lot more products coming here, electric vehicle products. Electric vehicle share reached about 5.5% of the market last year. It's going to rise even further from here. And we're expecting over 1 million EVs sold in the market in 2023. So the outlook remains quite optimistic. And as I mentioned before, the Inflation Reduction Act could help spur a tremendous amount of electric vehicle activity. Certainly on the sales side, because of that $7,500 rebate, although it's very difficult to qualify for that, and not many vehicles do just yet. But more and more vehicles will start to qualify that in coming years as more and more factories are built that are producing vehicles and producing batteries here in the United States. But as I said, the commercial vehicles, the rules don't apply. Commercial vehicles can take that discount right away. And so we might see quite a bit more of fleet activity with EVs as well as I said before, leasing activity. But the other interesting thing is really what's been changing over recently is just sort of this consensus thinking about EVs and how they're going to take over the world. This is a chart I found on LinkedIn that's showing Boston Consulting Group's EV outlook over the last few years. And I just thought it was kind of interesting that back in 2018, they were forecasting that by 2030, only about 21% of the market would be EV sales. But you can see that their thinking on that has been rising dramatically until the most recent data point I saw was they now think that by 2030, 53% of the market is going to be electric vehicles. So the penetration rate of electric vehicles has really started to take off. Everybody's kind of on board that these things are going to rule the world. I'm a little bit more skeptical, but I don't do long-term EV forecasting. We actually at Cox purchase a forecast from IHS, which is now S&P Global. And they have a bunch of analysts that actually look at the long-term outlook. And this is what their forecast is. And I think it's pretty interesting that their own forecast has EV share reaching 45% of the market by 2030. And that's what you can see there on the left, the battery electric market share. But I think what's really interesting is the role of hybrid vehicles here over the near term. We're expecting to see a big growth in hybrid vehicle sales throughout the rest of this decade, but then it's going to start to decline. It really looks like that hybrid is just kind of an intermediary solution. It's going to have a bit of a run up, but then it's going to start to decline as more and more folks shift to just pure electric vehicles out there. The other interesting thing on this chart is the role of as ICE vehicles, internal combustion engines. You can see that they're expected to fall dramatically. And I think it was last year that California announced that in 2035, they weren't going to allow any more gas vehicles to be sold in California. And that sounds quite dramatic. That statement sounds like, oh my goodness, how could you not allow that? When we look at S&P Global's long-term forecast, they're expecting by 2035 that ICE vehicles will be far less than even 10% of all production out there. So they're not even going to be that many vehicles out there. So it sounds like a dramatic change from California, but the thinking out there from the manufacturers themselves and from many of the forecasters is that the market's already going to be moving towards that position. But I just like to point out that for all this talk about EVs taking over the world, we still have a lot of gas vehicles out there. And in fact, right now, we currently have about 280 million light vehicles on the road today here in the United States. 99.5% of them use gasoline or diesel fuel. So only a very, very small portion are using electric vehicles. With the average age of a vehicle over 12 years, it's going to take a very, very long time for this ICE engines, these gas engines, to cycle out of our vehicle park and being replaced by electric vehicles. It's going to take decades and decades. And the recent run up we've seen in used vehicle values is just going to make that transition that much more difficult. And I just did some quick math. In 2022, in 2019, the average age or the average value of a 12-year-old vehicle at auction was about $3,900. In 2022, the average value of a 12-year-old vehicle at auction is $5,500, over a 40% increase. That suggests that vehicle park, those 280 million vehicles out there, are just worth that much more money today. They have much greater value. And so the economics of keeping that vehicle working, of spending the $5,000 and getting that transmission fixed, or spending the $5,000 and getting that engine replaced, all of that makes much more economic sense now, given that vehicle now has higher value. So I just wanted to point out, I think it's going to take a very long time to transition out of this. And I think it's going to be a real challenge for car dealers to maintain the fixed ops necessary to provide the service that all of these new electric vehicles and technological components like driving assist features and lane departure warnings, all of that new technology, and being able to service that and still being able to change a carburetor, to clean an air filter, all of the the old vehicle basic functions. They're going to have a wide array of skill sets in their fixed ops to really service the entire portfolio of vehicles that are on the road out there today. And the other thing I just like to point out is that, are we looking at a future chip shortage? Will all of the difficulty we've had finding chips in the market over the last couple of years and the impact that's had on production, will replacement chips be available for these vehicles 10, 15 years from now? That air pressure monitoring system needs its own chip. That automatic rear window needs its own chip. Are these chips going to be backward compatible? Are people going to be able to get access to these? More and more of these chips are going to be needed across those millions and millions of old vehicles. Are they going to be available? And I think that's another question that is going to be a challenge for the industry going forward. So those are my big comments. Really, I just think I think the best approach here for 2023 is to take a certain level of cautious optimism. I think there is reason to be optimistic that sales could remain relatively strong this year, even in the face of all of the headwinds that we have coming. but I do suggest to you that the second half of this year could be more difficult. And I think it would be prudent to maybe have some contingency plans out there of here's what we're going to do as our business, assuming we don't have a recession, and here's what we're going to do if we see things get much more difficult out there, because we could start to see things change here in just a few months. So those are my comments. I hope that's helpful. And if you have any other questions, please feel free to drop me a note. I'd be happy to answer them for you.
Charlie, thanks so much for joining us today and for helping us kick off our spring series with this market review. It's so incredibly relevant, and I love how you do every slide and you just make it really easy to understand. We really appreciate it, and we look forward to having you on again in the summer.
Great.
Again, you will all be receiving a copy of this webinar by early next week. To those on the line, join us back here this Tuesday, March 21st at 2 p.m. Eastern as Formatic Digital presents Are You Leveraging Video Effectively? So be on the lookout for promotions. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.